Welcome back to the deep dive. Today we're tackling something that I think a lot of people maybe don't quite understand. It's your credit utilization ratio, and it's really important in your financial life. So we've got a stack of articles here from Bankrate, Experian,
Oh, yeah.
TransUnion, and Equifax, all digging into this credit score superstar.
Yeah, it's fascinating how many people, I think, focus so much on the score itself
Right.
and don't realize this ratio is kind of like the secret sauce to it.
It really is. It's like trying to bake a cake and not knowing you need flour.
Yeah.
So for our listeners out there who maybe haven't heard this term before, what exactly is credit utilization?
Yeah, so basically it's the amount of available credit that you're using at any given time.
Okay.
So let's say you've got a credit card with a $10,000 limit and you've got $3,000 on it.
Right.
Your credit utilization is 30%.
Okay, that makes sense.
Yeah.
But I've heard that there are two types of utilization, individual and overall.
Right.
Does it really matter if one card is maybe a little higher as long as my total usage across all my cards is still low?
It can,
Mm-hmm.
because let's say you apply for a loan and the lender looks and sees that one card is maxed out.
Mm-hmm.
Even if your other cards have zero balances, it might raise a flag to them. Like, oh, are they suddenly relying on credit a lot more? So
Oh,
that one high card can be kind of a red flag, even if the overall picture seems okay.
so it's not just about like the total amount of debt,
Right.
but how you're kind of spreading it out on your cards.
Exactly.
That's a good point that I hadn't even really considered. So everyone says keep it under 30%, but I've also heard not to aim for zero.
Right.
So is zero debt not the best thing?
Well, it's a little counterintuitive, but having a little bit of utilization shows that you're actively using credit and managing it well.
Okay.
In fact, Experian found that people with the very highest credit scores, 800 and above, they actually average just over 7% utilization.
Oh, wow.
They're not avoiding credit, they're just using it strategically.
Interesting. So it's about finding that balance.
Right.
Like you can handle it, but you're not going overboard with it. How much
Yeah.
does this actually matter to my credit score, though? I mean, we hear about all these different factors.
Sure.
How big of a deal is utilization?
It's pretty big. It makes up about 30% of your FICO score.
Wow.
And it's a significant part of the Vantage score as well,
30%.
30%, almost as much as your payment history, which is the #1 factor.
Oh, wow. That is way more than I thought it would be. So, like, even small changes in my balances could actually swing my score up or down.
Yeah,
Especially if I don't have like a ton of credit cards or super high limits.
exactly. Especially if you have shorter credit history or, fewer accounts. Even a small increase on one card can really push that percentage up and affect your score.
Okay, this is where it gets really interesting. Now, Experian mentioned this new FICO 10 suite and how it uses trended data.
Yeah.
What does that even mean for like the average person?
Well, basically, FICO 10 isn't just looking at your current balance.
Uh-huh.
It's looking at how you've been using credit over the past 2 years.
Oh.
So it's looking at the trends. Are you paying in full consistently? Are your balances steadily increasing? It's really kind of like a financial time machine looking at your habits.
So it's not just about like what I'm doing right now to get my utilization down.
Right.
It's about like the whole pattern over time.
Exactly. And this is where that idea of being a transactor comes in.
Okay.
If you're paying your balance in full every month,
Oh.
FICO 10 sees that as a really good thing.
Mm-hmm.
It means you're in control. You're not letting debt pile up.
So FICO 10 is basically saying like use your credit card like a debit card.
Yeah.
Spend what you can afford,
Exactly.
pay it off right away.
Right.
Got it. Okay, that makes a lot more sense now.
Yeah.
So it's really about building those good habits now because they're really going to pay off with these new scoring models.
For sure. But FICO 10 is more than just trended data. It's also tougher on certain things.
Like what?
Well, Experian mentioned that late payments are having a bigger impact now.
Oh.
And credit card debt in general, especially with high utilization, is a bigger deal. And they even talked about personal loans. While those can be useful, they could potentially hurt your score more now, unless you're using them strategically.
Like consolidating credit card debt to lower your overall interest payments and get your utilization down.
Exactly. It's
Yeah.
not about, demonizing any one kind of debt. It's understanding the nuances of how FICO 10 is looking at your whole picture.
So it sounds like FICO 10 is really pushing people to think long term and build those good habits.
Yeah,
It's not about the quick fix.
Right.
It's about a sustainable approach to credit.
I think that's a great takeaway.
Okay. So with all this in mind, let's get into some strategies that our listener can actually use
Yeah.
to start lowering their credit utilization right now.
Yeah.
Let's give them some real actionable steps that they can implement today.
Great. Well, one of the simplest things you can do is um, is timing your credit card payments strategically.
Oh, so you mean like paying more than the minimum? I know that's important, but like how does the timing actually play into that?
Yeah, it's all about when your issuer reports your balance to the credit bureaus.
Okay.
Usually it's around your statement closing date.
Hmm.
So even if you pay your card in full by the due date, if you had a high balance on the closing date, that's what they're reporting.
Yeah.
And that affects your utilization.
So it's like they're taking a snapshot of your debt at that moment.
Right, exactly.
Okay, that makes sense. So paying it down even a few days before that statement closes could make a difference.
It can, especially if you're working with lower credit limits.
Gotcha. Okay, so timing those payments is key. We also talked about requesting a credit limit increase.
Yeah.
Can you remind our listener why that's helpful and maybe address some concerns they might have about that?
Sure. So a higher credit limit means you have more total available credit.
Okay.
So even if your spending stays the same, your utilization percentage goes down.
Uh-huh.
It's like having a bigger pie, so
Mm.
the same size slice is a smaller portion.
Right.
But I know some people are hesitant because it can trigger a hard inquiry on your credit report.
That's what I was going to ask about. Is it worth the potential hit to my score?
It often is, especially if you're actively trying to improve your utilization.
Okay.
That temporary dip from the inquiry is usually outweighed by the benefit of having lower utilization in the long run.
Okay.
But it's always wise to do your research. See if your issuer does a hard pull for increases and weigh the pros and cons for your own situation.
Don't just jump into anything without knowing what you're getting into.
Right. Speaking of which, we talked about balance transfer cards
Yeah.
as being a potentially helpful tool. How do those work, and who might they be good for?
So imagine you've got a balance on a high-interest credit card, and you're really struggling to pay it down.
Yeah.
A balance transfer card lets you move that balance to a new card with a 0% APR introductory period.
So you're basically getting a break from paying interest sometimes for like a year or more.
Right.
That's amazing.
Yeah, it can be a big help for people who are really serious about tackling their debt.
It gives them some breathing room to pay down the principal without that interest accruing.
Okay, so balance transfer is great for high-interest debt.
Mm-hmm.
And then there are also debt consolidation loans.
Yes.
How are those different and how do they fit into this whole utilization thing?
So debt consolidation loans are another good option if you've got a bunch of different credit card balances.
Okay.
You take out a personal loan, use it to pay off those cards, and then you've just got one monthly payment to manage.
That sounds a lot simpler.
It can be.
Yeah.
And if you can get a lower interest rate on that consolidation loan than what you were paying on the cards, you'll save money in the long run.
But are there ever times when a debt consolidation loan maybe isn't the best move?
That's a good question.
Yeah.
Sometimes people see it as a quick fix,
Mm-hmm.
but it's important to actually deal with the root cause of the debt.
Right.
If you consolidate, but then keep overspending on your cards, you're going to end up back where you started.
So it's not just about like shuffling the debt around,
Sure.
it's actually changing those spending habits too.
Absolutely.
Yeah.
Like rearranging the furniture in a messy room.
Mm-hmm.
It might look better for a minute, but you didn't deal with the clutter. It's just going to come back.
That's a great analogy. So we've talked about dealing with existing debt, but how do I prevent new debt from piling up in the first place?
Well, that's where building those good financial habits comes in.
Yeah.
It sounds basic, but creating a budget and tracking your spending can really make a difference.
Yeah, I think a lot of people kind of roll their eyes at the word budget,
I know.
but it doesn't have to be this restrictive thing. It's more about just like understanding where your money's going
Exactly.
and making intentional choices about your spending.
Exactly. A
Yeah.
budget gives you the power to decide how you want to use your money rather than it just disappearing.
Right. And I've heard you talk about automating your finances.
Yes.
Can you say more about that?
Automating can be huge, especially if you have trouble staying organized or remembering due dates.
Yeah.
Setting up automatic bill payments means you never miss a payment, and you avoid those late fees that can hurt your credit score.
And what about automatic transfers to savings?
Yeah.
How does that tie into lowering utilization?
Well, it helps you build up that financial cushion so you're not as tempted to use credit cards for unexpected expenses.
Yeah.
The more you save, the less you have to borrow,
Yeah.
and the lower your utilization stays. It's all connected.
Okay, this is all great advice, but it can feel overwhelming to try to do all of this at once. What's the most important thing for our listeners to take away from this?
Be patient. Building good credit and lowering your utilization takes time, and it takes effort.
Yeah.
It's a marathon, not a sprint. Celebrate the small wins, track your progress, and don't get discouraged if you don't see results right away.
It's like training for a marathon. You don't just go out and run 26 miles on day one. You
Exactly.
got to build up to it.
Right. Focus on those sustainable habits. Be kind to yourself and trust the process. And remember, you don't have to do this alone.
Yeah.
There are tons of free resources that can help you.
Yes. Let's talk about those and give our listeners some concrete steps they can take.
Okay, so you're saying even if I don't want to overhaul my entire budget right now or dive into debt consolidation, there are still things I can do
Yeah,
to
definitely.
start getting a handle on my credit and making smarter choices.
For sure. There are some amazing free tools out there that can make a huge difference.
Like what?
Well, for instance, Experian has a really great credit monitoring service that you can sign up for,
Okay.
and it'll actually alert you to any changes on your credit report.
Okay.
So, like hard inquiries, new accounts opened, even potential signs of fraud.
So it's like having a security system for my credit, basically.
Basically, it's keeping an eye on things for you, making sure nothing shady's going on.
I like that.
Mm.
Okay, what else?
Another one that's really cool is the Capital One CreditWise app.
Okay.
It's totally free for anyone to use, even if you don't have a Capital One card.
Oh, wow.
And it'll track your credit utilization, give you personalized tips for improvement, and even let you simulate how different actions might impact your score. So, like, if I paid down a balance or opened a new card, I could actually see what it would do.
Exactly. It's like a little credit score simulator.
That's cool.
It takes out the guesswork,
Yeah.
helps you make informed decisions.
Okay, that's awesome. Now, what about seeing my actual scores from all three bureaus?
Yeah, you can do that too with my FICO.
Okay.
It is a paid service, but it gives you that full picture of your credit health from all three bureaus.
And that's important, right? Because different lenders might use different scores.
Exactly. So it's good to know where you stand across the board.
Okay, so lots of tools to help us stay on top of this, but it's important to remember that credit utilization, it's not the only thing.
Right. It's
Oh.
just one piece of the puzzle.
It's easy to get fixated on the numbers, but it's really about those healthy financial habits.
Absolutely. It's about living within your means, managing your debt responsibly, and making conscious choices about your spending.
And your credit score just kind of reflects all of that.
Exactly. It's like a financial report card,
But it's not just about the grade, it's about what you learn from it.
right? And using that knowledge to build a better financial future.
I like that. And if anyone's feeling overwhelmed or unsure where to even begin, there are professionals who can help.
No, yeah, for sure. Financial advisors, credit counselors, they can give you that personalized guidance and support.
That's so important to remember. You don't have to figure this all out on your own.
Definitely not.
Well, I think we've given our listener a lot to chew on today.
We have.
We've covered what credit utilization is, why it's so important, and how to actually take control of it.
Yeah, we've given them the knowledge, these strategies, and the resources to start making positive changes.
So as we wrap up our deep dive into credit utilization, we want to leave you with one final thought. If a high credit utilization ratio is a red flag for lenders, what does that tell us about how we should be handling our own money?
It's a good question. Are we being as financially responsible with ourselves as we would expect others to be with us?
That's something to really think about. Until next time, happy diving.